Okay, today is December 11th, and we're excited to welcome a special presentation from Kinsted Wealth. We have Nick and Alex. They're wealth counselors with Kinsted, a local portfolio manager in the Calgary area. We would like to share with you some options about investing money in ways that often people don't have access to. So thank you so much for coming out today, Nick and Alex.
Yeah, no, and
Thanks,
thanks for having
Crystal.
us. Yeah, thanks for having us, Crystal. It's always great to do these kind of things, and I think hopefully we provide a bit of education here and touch on a little bit of what's happened over the last couple of years regarding inflation and interest rates, and then get into some options and some things that we're seeing in the market environment. So I'll pass it off to my colleague Alex to start off with just a quick discussion around inflation and interest rates.
Yeah, thanks, Nick. As Nick mentioned, we thought it'd be a good idea kind of start with a little bit of an education piece, just to understand the interest rate and market environment that we're seeing today. So starting with inflation, the last couple of years have been an interesting time for all of us. Prior to 2020 and the global pandemic, inflation was hovering around 2%, which is the target that the central bank sets out. And sometimes it even got down to about 1%. So with interest rates being, around this 1-2% for so long, it left very little room for the central bank to use what we call stimulative monetary policy to increase economic growth or inflation. So as we know, the lower the interest rates are, the money supply increases. And this is because people, they want to borrow more at these low rates, and actually their ability to borrow is higher at these rates. So in 2020, when inflation dropped very low, this was due to a number of factors, but probably we can almost relate to the lockdowns. And this put a hamper on consumer spending. So what the Bank of Canada was forced to do to get inflation back up to that target rate was to decrease rates to close to zero. They're at about 0.25% for a little while. And this was just to encourage people to get back out there and spend. But unfortunately, as we know, it kind of created the perfect storm. We had low rates, and then we also had the government assistance. And they were injecting more money into the economy. So this created a lot of consumer demand because people had excess savings from the pandemic. And then also we had a backlog of manufacturing because people weren't working in the plants. And also, just to add on another layer, we had global wars, which were pushing costs up. So it really was igniting inflation from both ends of the stick. So it created a lot of problems for everyone.
I don't think anybody's seen that in their lifetime, especially
No.
in the two generations that we primarily serve. So
Exactly.
Yeah, it's people have been used to the past decade, right, of low interest rates, low inflation, and I think what we're going into, to what Alex has alluded to, was that is not going to remain the same, right? And going forward, we're going to expect to see, inflation will likely come back down, but I think the secondary conversation is on where rates will fall, right? And I'll let Alex chat more about this, but it is the fastest tightening cycle that we've seen on record. So keep that in mind when we go through this, right?
Yeah. So, going into the rate hikes, and, this has been front page news for everyone for the last year and a half-ish. So, the Bank of Canada, they tried to combat this rising inflation, which really happened so quickly. And they really wanted to cool the economy and get it back down to that target rate. So what they did, instead of using stimulative monetary policies, what they used was restrictive, which essentially just means increasing interest rates. So over the last about 20 months, they increased interest rates by about 4.75%, which, as Nick alluded to, is the fastest rate tightening cycle since the 90s. So what does this mean? History suggests it takes about 18 months for increases in interest rates to actually make their way through the economy, decreasing growth and causing slower growth or a recession. So this means, as a whole, we're just actually only starting to see the impact from the first increases, which I'm sure for a lot of people it doesn't feel like that. Especially those who have floating rate debt through a line of credit or maybe a variable mortgage rate, or they've already been forced to renew or initiate a mortgage. And other people are feeling it in places like the grocery store, or restaurants are becoming more expensive, or buying a new car. So I think as savings deplete, we're forced to renew more of our debt. The recessionary environment becomes a lot more evident. So I think going forward, we're all hoping that inflation continues to cool, and we hope that the Bank of Canada continues to hold stagnant or maybe even starts to cut rates at some point in the future.
Okay,
Right.
that's awesome.
So-
Hopefully some rate cuts a little bit with all the mortgages coming up.
Yeah. Nobody knows. Crystal ball, right?
Should I be locking in my 5-year fixed, or should I wait the next year, Alex? What's your
Oh gosh, you're asking me that.
The question everybody's asking right now.
Yeah. If only we all had the answer to that, I think it'd be a different
But
story.
It's a good touch point on the impact the consumer's having and how we're seeing that bleed through to the capital markets, and specifically the capital markets on publicly traded stocks and bonds. And so what you see here on this chart, and I just pulled this rate from Morningstar, so it is up to date as of last week, but this just shows kind of two asset classes to highlight this change. And the blue line you're looking at is the NASDAQ 100 index, right? And it's basically from its peak in December of 2021 to last week, right? So you can see that it's been quite a ride from its top, and we're almost coming back to its all-time highs. We're still slightly down at about 1.66%, but this is an index that's comprised mainly of the stocks you hear in the news. So the Apples, the Microsofts, the Nvidias, the Netflix, the Teslas, the very what we call growth companies. And these companies are the most susceptible to changes in interest rates. And the reason for that is the way that we value them today is we basically take all of their cash flows, which are way, way out in the future because they are growth and we're anticipating that they're going to have a lot of cash flow in the future. And we discount them back to today. And the rate at which we discount them is, in fact, the rate that the central bank set, right? Which we call the discount rate. So without getting into the math of it, what you can see is in December of 21, when rates started going up, these technology stocks got hit hard. They were actually in a drawdown of about 30% through 2022. Now they've rallied and come back quite significantly in 2023. And that's because, again, markets are looking at, okay, our rate's going to come down, and that drives the price up. But the more interesting line on this chart, in my opinion, is the red line. And this is an index of long-term bonds. And the way bonds are priced is effectively as interest rates go up or down, bonds go the opposite direction. So as we've seen rates go up, bond prices have come down. And truthfully, it's really just the way the math works out. So again, there's a discount rate in the denominator, and I won't go down that rabbit hole. But effectively, as rates go up, the price comes down, and those bonds actually have a higher yield. So what we see going forward is there's now options for investors in the bond market where they can actually earn a little bit of yield, right? But I'm sure, Crystal, with clients that you work with, you've seen a lot of people been impacted by that bond market, right?
Well, the guidelines were always to have people to expose to less risk as they get older, and so they were more exposed to that market specifically, with the hopes that there's less volatility. But that didn't happen, and that's relatively unusual.
Yeah,
exactly. It's very, very unusual. I think this is if not the largest drawdown that we've seen in the bond market on record. So in a way, if you're watching this, you're kind of living through history on that side of it. And going forward, right, it's actually now provided investors with some options, which...
Well, it's at negative 32%, which...
Say that again?
That negative 32% on the right,
yep.
That's a huge number. Those weren't supposed to fluctuate more than, 4% each way, or it was not supposed to be a swing like that.
Yeah. You'd see that in the equity market maybe, but definitely not in the bond market. Yeah.
Exactly. And it's going to take longer for something like that to recover, in my opinion, right? Because the long-term impact, and they have to reinvest, and the rates are changing so quickly. So the equities, yes, they can swing that hard, but they also tend to recover faster.
Yeah.
As you 100%. Can see.
Exactly. And I think when we get to the end of this, we'll be able to show some options and what Kinsted is doing in areas that you can diversify outside of just bonds or stocks, right? Because they are susceptible to interest rate changes and inflation impacts, very, as you can see by this chart, quite significantly, right? Um, what's interesting, just as a side note here too, is what's happened as these rates have come up is people have flocked to GICs and money market funds.
Yes. Yeah.
We saw this happen in 2020 during the COVID pandemic. It's actually amplified in 2023, as you can see by the red line on this chart. We've seen about $1.5 trillion flow into these money market funds, right? And what that means, there's two ways that can go: is either A, they stay there, or B, there's a pile of cash sitting on the sidelines looking to get into longer term asset classes like stocks, like bonds, like private markets. So we're not sure what the future holds, but there is a lot of cash on the sidelines, right?
Yeah. That's a scary number. It used to be, I remember hearing back years ago, oh, there's 500 million in GICs. And we thought that was a lot in GICs. And now that's nothing in comparison.
Yeah,
exactly. And I have this next slide here because the GIC debate we see a lot in our industry. I get a lot of questions around, and I'm sure everyone else on this call does, around why wouldn't I just park my money and if I can earn 5%? Right. And if it's for a short-term purpose, if you're saving for a car in the next 6 months, a wedding, a new house, a large purchase that you're going to have to make, it's a great option. And I would never sit on the end of this end of the screen and say don't do it, because now you're actually compensated a little bit to hold your cash that you need in the short term. What we know, though, and what we'll get into a little bit, is that it's still not a good long-term investment vehicle. The GICs tend to be based off the risk-free rate, and all other asset classes are based above that. So over the long term, we would expect stocks, bonds, and private equity, real assets, private debt to actually perform above GICs. And historically, they have done that. So that's why we still don't feel they're a good long-term option. The second question is, well, maybe instead of replacing stocks or private assets, what about replacing my bond portion of the portfolio with a GIC? And so I found this chart from Manulife at the end of 2022. And what this chart shows, right, is the amount of time, the percentage of time that GICs underperform bonds, right? So what you can see on the left side of this chart, there's three lines that go from less than 5% to 0%. Mm-hmm. And what that's saying is about 25% of the times a GIC actually outperformed a bond. And it's the FTSE Canadian Universe Bond Index. So GICs were actually the right choice. But on the flip side of that, what that means is that 75% of the time, the FTSE Canadian Universe Bond Index actually outperformed a GIC. And if you look at the actual height and the percentages of those bars, it's much more significant, sometimes 7.5% to 10% greater than what a GIC offered. So what we're trying to showcase here is we always believe that instead of trying to get it right 25% of the time and maybe time the markets correctly, you're better off to, again, stick to a long-term plan, and bonds tend to outperform GICs majority of the time, right? So we like to be on that end of the aisle versus trying to time the 25%, right?
Mm-hmm. Yeah, the timing is crucial, right? Because we think we can time the markets, but if it's already going up and you decide to get back in out of a GIC, is your GIC locked in? That's the other piece. You can't always lock in your GIC at the perfect time and have it, up for renewal right when things are going to take off and you'll know they're taking off. Yeah, so the timing can really be problematic and make those numbers, I think, a little worse.
Well, and certainly, and then you're dealing with the liquidity of it, right? Now you've actually locked your money up for 5 years, maybe, right? Which you get, and that's a big thing people don't always consider, is the flexibility that other asset classes can offer, right?
Yeah. Mm-hmm.
So I think, to wrap it all home, we're going to talk a little bit about what Kinsted's doing and in our partnership with the Holden Taylor team, and how we came to kind of our current investment philosophy and what we think is one of the most innovative wealth platforms in Canada, right? And we're following some of the giants, some of these names that you're going to be familiar with, what we call the pension model. So I'm going to pass it back to Alex here to chat about something that's a little bit close to home, our very own Canadian pension plan. So Alex, I'll let you jump into there.
Yeah, and Nick has mentioned about the smart money, and that's what we call pension plans and endowments, and that's because they are always kind of ahead of the curve, and they're always looking to what's next and what's the future of investing hold more than I think a lot of other managers in the space. So we like to use the CPP example a lot, probably a little too much because it's so easy for everyone to relate to. 20 years ago, 24 years ago, in 1999, the CPP was, having a lot of issues. There was people who were thinking, why am I contributing my money to the CPP when it's probably not going to be available for me when it's my time to retire?
Mm-hmm.
And I remember my parents saying that. So, back in 1999, it was 100% bonds and 100% Canada. And there's issues to this for two reasons. The first being you're 100% exposed to Canada and you're living in Canada. You don't really have any diversification to when the Canadian economy is not doing well, then your fixed income's not doing well. And it's just very tied together. So it's very concentrated risk. When they started to diversify their platform, they started to move into more global assets. There's just a lot more available. The Canadian universe is really only a small percentage of what's out there, maybe like 3% or less. I could be wrong. But and then they moved into the traditional portfolio, which is that 60-40. And what that means is just you have 60% allocated to your growth assets and 40% allocated to your capital preservation or bonds, or what they should represent. And so as they started, sorry, what was that?
Basically a balanced profile.
Yes, exactly. So what they started to realize was that there's so many other asset classes out there, and this is what Kinsted's done as well. So you've got your real assets, which are things that you wouldn't think that are available to the average investor. Things like infrastructure projects, very large scale infrastructure projects, agriculture, timberland. Things that are tied to inflation and actually participate in inflation. When you're getting hit at the grocery store, some of these other asset classes are actually performing well. So really nice complement to your portfolio. Things like private credit, which is essentially just privatized debt and credit for you. So it's a lot of the time floating rate assets. So again, in the interest rate environments we're in now, we see these asset classes do a little bit better than traditional fixed income. And so, again, what Kinsted's done is really try to follow this model. And we've, let's go to the next slide here so I can show you a bit about what Kinsted does. And Nick and I can speak to the platform a little bit deeper. But this is sort of what your portfolio could look like. And again, every portfolio is going to be a little different, determining, risk and many other factors that go into it. But you've got a lot more arrows in your quiver, which we like to say that a lot, but it's really true. You have a lot more tools at your disposal to navigate, interesting market environments and interest rate environments and inflation. So, Nick, was there anything you wanted to add on sort of the Kinsted platform or?
No, I love the arrows in the quiver. I'd like to get that tattooed eventually.
I feel like you will.
I totally agree. It's again, a lot of these asset classes are used as volatility dampeners and return enhancers in some cases for a traditional portfolio of, say, equities and bonds. And it just allows us to get a little more granular for clients who say maybe don't want a whole lot of risk in their portfolio and they're comfortable with a targeted rate of return of 5%. And it allows us to hit that targeted rate of return with the least amount of risk possible. And that's what we're trying to achieve at Kinsted, and what we have achieved is building out a platform that just works better for investors, in our opinion, than a traditional 60-40. So, no, Alex, I would echo all your comments. And, I think if there's any information anyone needs from us, always feel free to reach out or go through Crystal and her team at Holden Taylor. And I think the purpose of today was just to provide a little education, as well as just a little bit of background of what we've seen over the last 2 years, because it has been very volatile. And to be quite frank, I would expect the next 5 years to be very volatile as well. We just don't know what's going to come up, and there's always something new around the horizon. So we just try to build portfolios to, prepare for what's next, not trying to guess what's going to happen, right? We're just trying to prepare as best as possible. So thank you, Crystal, for having us on. Again, really always appreciate working with you guys.
Thank you so much, guys. Thank you. I hope you have a wonderful Christmas.
You too.